Hey everyone, welcome back to Corporate Decoder. Today JXN Incorporated just filed an 8K about a new credit agreement, and I am seeing one key detail that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. Jackson Financial is tapping into a huge new credit line, and it tells us a lot about their strategy. Alright, let's dive into this filing from Jackson Financial Incorporated. This is a report called an 8K, which basically means the company is reporting a big, important event that shareholders need to know about right away. The main event here is that on the 30th of June 2026, Jackson Financial Inc. entered into a new credit agreement. Think of this like a company getting a really big loan or a line of credit from a bunch of banks. This new deal is quite substantial. This new credit agreement is for a massive $1.25 billion. This is a huge amount of money, and it is primarily for the company's working capital, which means the money they need to run their day-to-day operations, and for other general business needs. On top of that, they have a sublimit of $500 million specifically for letters of credit. Letters of credit are basically guarantees the company can give to others, assuring them that payment will be made. It's like a promise backed by potential funds. What is really interesting is that the company can also ask for an increase in these commitments by up to another $500 million. This shows they are planning for potential future needs or growth opportunities and want to have that financial flexibility readily available. The interest rates on any money they borrow can be based on either a base rate or a term SOFR rate. The margin, which is like the extra percentage they pay on top of the base rate, can range from 1.125% to 1.875% for term SOFR borrowings, and from 0.125% to 0.875% for base rate borrowings. The specific margin depends on the company's credit rating. Importantly, these borrowings are unsecured, meaning they are not backed by any specific company assets. This new credit line doesn't just appear out of nowhere, it actually replaces their older credit agreement from February 2023, which was for $1 billion. This new larger credit line extends their financial runway significantly, with commitments lasting until the 30th of June 2031. Plus, they have options to extend that date even further. Like most large loans, this agreement comes with certain conditions the company must meet. These are called financial maintenance covenants. They have two key ones here. First, they need to maintain a minimum adjusted consolidated net worth. This is calculated by taking 65% of their net worth as of March 2026 and adding 50% of any increase in net worth from new equity they might issue after that date. The second covenant is a maximum consolidated indebtedness to total capitalization ratio, which they cannot exceed 35%. This means the amount of debt they have compared to their total capital cannot go over 35%. These are pretty standard covenants for a company of this size, designed to ensure they don't take on too much debt relative to their financial strength. Finally, as is standard with these filings, they've included the actual credit agreement as an exhibit to this report. This is the full legal document detailing all the terms and conditions of this massive financial arrangement. So, what does this all mean? Jackson Financial is securing a much larger pool of readily available cash. This usually signals confidence from the lenders in the company's future prospects and a need for more flexible financing, perhaps for growth initiatives, acquisitions, or to weather potential economic uncertainties. They are essentially giving themselves more financial firepower. The fact that they are replacing an existing credit line with a larger one and securing it for a longer period suggests they are proactively managing their financial structure and believe this new agreement better serves their long-term strategy. It also speaks volumes that major banks like Wells Fargo Bank, National Association acting as administrative agent, are willing to extend such significant credit, implying a healthy level of trust in Jackson Financial's management and business model. What I'm actually looking for is how they will deploy this increased capital. My biggest concern is always how a company uses its resources. Will it lead to profitable growth or just expand the balance sheet without much benefit? We'll have to watch closely. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please like this video, subscribe for more, and join our Discord community linked below.